Hey everyone, Michael here. Hope you guys are having a wonderful day. It looks like the government is trying to give out a ton of bonds because we still don't have enough money. For those of you guys that don't know, people haven't been paying their taxes, or tax revenues have just been crashing over the last year. So all this money that the government thought they were going to be able to have to spend, it's actually not there. So they're having to issue bond after bond after bond. So today we're going to be talking about that and how much interest is on our debt, because it just seems to be spiraling out of control, especially with this higher inflation. We're having to raise interest rates in order to combat that, which means that just holding debt is much more expensive, which is why the number one thing most people are doing these days is trying to pay off that debt or just not lose control, because the interest rates are going out of control for them personally, right? Now, let's talk about this, and we're going to watch a short CNBC video, and then after that, we're going to be talking about that debt, okay? Let's get started.
Some breaking data from the Treasury Department on its funding needs. Steve Leisman joins us now. Hey, Steve.
Good morning, Joe. The Treasury announcing it will auction $120 billion of Treasury securities in the coming quarter. That seems to be around what I've read is the expectation of the market. So unlike, it is an increase, but unlike last time, maybe not a huge surprise. We'll see how the market reacts. Treasury refunding $102 billion and then raising $9.8 billion in new cash. That's how you get to 112. It's saying it will continue to gradually increase coupon and auction sizes for at least one more quarter, and that's across tenors, 2, 3, 5, 7, 10s, and 30s. Didn't mention the...
And then, of course, I just want to let you guys know they're planning to sell $48 billion in 3-year notes and quarterly refunding, so they're adding on to that as well.
20 in terms of increasing sizes there, and it's going to boost, it seems to be, the 2 to 5 year notes more than the 7 to 10 year notes, so leaning just a touch more toward the earlier, shorter tenors in the Treasury coupons. It will maintain current bill auction sizes, it says, and auction sizes will be reduced modestly. Bill auction sizes will reduce modestly beginning in early December. They also add they're making significant progress on a technical plan here to implement a regular buyback, essentially, of off-the-run securities that's expected in 2024. Joe, let me just be clear here. We're all sort of equity tourists in the fixed income market. We're watching this because obviously the fixed income market is going through something right now in terms of digesting a whole bunch of new issuance coming down and financing these larger deficits. And we're stepping in to see how they're digesting this. I'm interested to see what's happening to the 10-year. It looks like pretty much unchanged, I think, if I'm right, maybe a little bit more on the 30-year. There was a big surprise. Fitch announced a downgrade the night before the August refunding. August refunding was larger in terms of what was expected. The Treasury since then, I think, has been out there basically telling people, look, expect bigger auction sizes, bigger coupons, and maybe this is less of a surprise to the bond market, maybe less of a surprise, therefore, to the equity market. Joe?
Yeah,
Okay, I don't want to hear the back and forth between the two, but the big thing here is this. There are a lot of people out there that want the stock market to go up. I'm sure that you guys want the stock market to go up. But as they give out all of these bills and they raise interest rates, and you see that bonds are pretty lucrative things, if you're an older person and you don't want to buy on the potential eve of a major recession in the United States, you're going to be buying these, 2-year notes, 5-year notes, where you guys can get 5% yearly interest for letting them hold your money for 2 years. And usually when we're in a bad rut, a recession or something like that, it usually lasts for a year, 2 years. And of course, you guys don't have to use the 2 or the 5. There's also 1-year notes, 6 months, stuff like that. And it just seems that people are going to be more enticed to buy these, especially hedge funds, instead of having to worry so much about the volatility of the market right now, because as you guys know, this earnings cycle was not that good, really not that good. You guys saw Google fall down about 12% in one day. That's crazy. That's a lot of money, just hundreds of billions of dollars flowing out of Google within a single day. That's not normal. And this goes back to that thought process here of, hey, guess what? Stocks can act like cryptocurrencies too. This is not the normal way it's been, but these days, now, everything is extremely volatile, which means just like last year, if we go through a bad cycle, it means everything can crash so easily. But if you're holding these bonds that the government is giving out to you at really good rates, then why would you even put yourself at risk? Or why would you open yourself up to more risk? Because, people like me, I own stocks, but am I going heavy in the stock market right now? No, I am not. So the last thing here is just this. I asked ChatGPT to kind of do some research for me, because I don't like to do it myself. How much of the USA revenue is going towards paying interest on our debts? Search online from multiple sources. That way we just have an idea. Sometimes it messes up. But basically it says the portion of the United States budget allocated to interest payments, there we go, on the national debt for the fiscal year 2023 is projected to be about a 10%, to be about 10%. So 10% of our revenue is going towards paying off our credit card debts. Imagine if that was you. You were making $100,000 a year, but $10,000 of it was actually going towards paying credit cards, the interest on credit cards, not paying the debt down, just the interest, okay? That's the important thing. All right, and that amounts to approximately $663 billion, all right? That's a shit ton of money here, guys. So it's supposed to go up, last year was only, last year for the fiscal year 2022, it was only 475 billion. All right, this year from 475 billion up to 663 billion, we still can't get our budget in order. And it doesn't seem like Republicans in Congress, even though they have control of the House, they're not going to be able to fix that. Or they're not willing to get nasty in order to fix it, if you get what I'm saying, like, close down the government, really start doing some deep cuts, because of course they have to compromise with Joe Biden and the Democrats in the Senate. Heck, they even have to compromise with Republicans in the Senate because they want to give unlimited money to Ukraine and stuff like that, and that's not where the House Republicans are at. So there's this weird thing going on right now where we just can't stop spending, and there's only maybe, I would say, 50 people in all of Washington, D.C. that really want to cut down on the debt. Until then, we're going to see this go higher and higher and higher and higher and higher until we lose control of it. But that shouldn't happen, for at least a decade, I would say, unless there's something really bad that happens right now. And I don't think that's going to happen. But let me know what you guys think. Are we going to get our house in order or no? Flip a coin.